Carl Dom here with your Real P&L channel. I just thought that David here asked a really good question, so I thought I'd make a video out of it. The question is, would you advise buying a lower price put or call that's relatively far out of the money? For example, if one were to sell a $150 put option, would you usually buy the $130, $140 long? So basically we're talking about when you put on a credit spread, where should you buy your hedge in order to protect you from a crash market or tail risk? So I'm going to get into that because I think that's a really good question. I did answer here, but I'm going to make a video out of it and make it more detailed. So first, let's talk about what is a crash market. First of all, let me just say that there are 4 types of markets, and in my book in chapter 11, my book is called The Portfolio for All Markets, 12 Options Trading Principles to Profit in All Market Environments. And in that, chapter 11 talks about the 4 different types of markets, and one of those is a crash market. How I define a crash market is when the VIX, or the volatility, rises 35 points or more over a 3 to 5 day period. So if we look at the VIX here, we can see, for example, on February 5th, 2018, where the VIX reached 50, and you can see a few days before that it was only at 13. So that would qualify as a crash market. Another qualification would be August 24th, 2015. And so let's get back into there. Right here, so we hit a VIX number of 53, and a few days before that we were only at 15. So you can see that 35 point boost within a 3 to 5 day period. That gives you a crash type market. The crash market is what you want to protect yourself from if you're selling premium. So the question is, how much protection do you need when you sell a credit spread? The first thing I'm going to do is put some type of context around what we're talking about. So I'm going to talk about the SPY. Okay, so let's go to the software where we can simulate some back tests here. I'm going to use SPY as my underline. What we want to do is choose a time right before we're going to see a crash. So February 1st is a good time. I'll go through this a couple of days. We'll go to the February 5th. You can see that there is a crash here. Okay, so we want to put on a trade right before the crash because that's kind of worst case scenario, and you don't want to get stuck, selling an option and then having to try to buy it back when it's worth so much more. So you want to understand this is a crash market, and you want to put on trades ahead of that crash market because that's worst case scenario, and that can blow up your account if you don't do things properly. So we want to put on a trade right here on February 1st so we can see what happens. So a lot of times if you want to sell naked, that people will go out to the 1 standard deviation. I'm going to use SPY, and I'm going to go out, let's say 43 days till expiration. So I have to use something, so I'm going to use SPY, and I'm going to use 43 days until expiration, and the 16 delta. So remember, 50 delta is at the money, so this is at the money, and you want to go out of the money a little bit. You can go 1 standard deviation out of the money. That would be about 16 delta. That would be the 267 strike that we would be selling. So you can sell that, and you can see down here you'd bring in about $133. A lot of times you can let that expire worthless and collect that whole $133, or you can take profits earlier and probably get a little better, higher probability of profit if you maybe take profits at 50%, so half of that. So when it gets to whatever half of that is, 65 bucks, whatever that is, you take profits. A lot of people do it that way. But let's just see what happens when you sell a naked option ahead of a crash. First, I'm going to use this risk chart, and if you don't use risk charts and you are trading options, you really need to understand how these work, because if you're not backtesting and using risk charts, you really don't know what's the potential is, or the potential loss could be on your trades. And if you don't know that, you're really not understanding your trades properly, and you shouldn't be trading, in my opinion. But anyway, so how does this risk graph work? It's kind of just to gloss over it really quick. You can see here's the price of your underlying, and then here's your profit, and here's your loss. So for example, if this is the expiration line, so if the price goes all the way down to 250, you can see that your loss would be around $1,500. So you're hoping that SPY does not fall down to 250. Okay, so we're selling the 16 delta here, and you can see what our potential is to make money. Our potential is to make about, what is this, $133. All right, so we'll have this trade on. I'm going to go ahead and commit it like it's a trade. And we'll see what happens over the crash period, which is 2 days from now. We know that already. And you can see that you're down $742. So you're basically trying to make $133, but your loss, or you're down 742. So 742 divided by 133 equals 5.5. So you're losing 5.5 of your potential profit. You're down 5.5 times that. So a lot of times you can get margin called at this point, and your account could be blown up. Because obviously, if you have more money, you're not going to just trade one contract. You could have 10 contracts, or 20, or 30. And you just got to multiply that times 5.5, and that's your loss. And what will happen is you'll get margin called, and they will close out your position for a loss. Or there's a lot of different things that can happen with margin calls. I won't get into the details of that. But this was what can happen. So what do? You want to stay away from naked positions. I would never sell a naked position personally. That's just not something I would do. So we were talking about spreads. So spreads, meaning we would buy a long. Where would we buy the long? Well, let's say we bought the long here at the 5 delta. So you can see your deltas here, and there's about 5 delta right here. So I'm going to buy a long. You can see how that kind of changes the risk graph. So you bought here, you sold here, and you bought here. So let's go ahead and do that, and just call it test number 2. Test 2, so this is the same naked option, but then it's not naked anymore because we spread it off, or we bought along at the 5 delta range. What happens in a crash? Well, let's go 2 days in the future, and you can see that you're down about half as much as what you were before. How much did that cost you though? So we did previously have $133, but now we only brought in about 90. So 133 minus 90 is about $43. So that long, or that hedge, cost you $43, or 43 divided by 133 costs you about 30%, let's just say. So if you spend 30% on a hedge, you can be semi-protected in a crash. There are better ways to do this, but this is one way. Spread it off, so when you get to a crash market, you can protect yourself somewhat. There's better ways to protect yourself, which I'll show you what you can do by spending the same amount of money. Okay, so you want to spend about $43 or so, about 30% of what your potential profit would be. But now I'm going to do something different. And I think this is more, it's not super advanced, but it's not something that I want to give away for free. But I'm going to show you what you can. I'm going to just give you the results. So there's better ways to hedge yourself against tail risk and still spend that $40 or that 30% of your potential profit. See here, I've got this short, and I've got something else on here where it's still got the same amount of cost. In other words, I'm spending the same amount of money on the hedge. Okay. I'm going to call this test 3. Now let's see what happens in a couple days. Again, spending that 30%. Okay, now you can see how you're much better protected, only down $159. So hopefully you guys learned something here on some of the importance of understanding a risk graph or using a risk graph and back testing is what I highly recommend that you do. And I hope that this answers the question that David had in the comments.